I think when it comes to BMNR, they are often seen as a company or misunderstood as a company that likes to dilute their shareholder base in order to raise capital. And I think with many people calling them a Ponzi scheme, that is somewhat of a lazy argument. Because by calling them a Ponzi scheme, I believe it discounts the narrative around the wider adoption of Ethereum and how that has the potential to affect their growth. And all of these are things that I have discussed in previous videos. But in this video, we'll be discussing some of the ways that BMNR can continue to grow even if they do not continue to issue shares. And I think more importantly, what this chart of MicroStrategy growing 25 times in 5 years has to do with the potential valuation of BMNR in the months and years ahead. But as always, potential is a dangerous word, so let's dive in. And so the idea of becoming a digital asset treasury, or a DET for short, is not a new one. Right, MicroStrategy was the first one who did it and did so very, very successfully. So, as part of his presentation, Tom Lee actually shared this chart that you're seeing over here. And what you're seeing is that MicroStrategy over the last couple of years has grown from $13 all the way up to a high of $335 in just 5 years. Now, despite the fact that they are trading, more or less flat year to date, hovering around $290, it is still up 22x from 2020 over the last 5 years, right? So, if you ask me, I think a lot of people right now are looking at MicroStrategy and say, you know what, your Ponzi scheme, your strategy doesn't work anymore. And people are basically calling them out. But if you zoom out and take a look at the bigger picture, I don't think you can call something that has grown 22x over the last 5 years a Ponzi scheme, even though it has stayed flat for the majority of 2025. And so Tom Lee is basically suggesting that this is the potential for BMNR, and I do want to explore if there's really a possibility for this to happen. Now, in order to keep up their growth, BMNR cannot, and I repeat myself, they cannot keep issuing shares forever. There's going to be something called shareholder fatigue, where people just get sick and tired of BMNR diluting shareholders and they feel like it is a never ending cycle, right? So at some point, investors will feel tired, they will feel irritated by BMNR, and because of that, the market will stop giving them a premium to their net asset value. And once that happens and they cannot recover from it, then their entire flywheel will start to collapse. Now, BMNR then has two weapons in their arsenal to accelerate their accumulation of Ethereum without causing heavy dilution to the shareholders. Now, the first of these two methods are called preferred shares, which is what you're seeing highlighted in green over here. So, preferred shares are basically like a hybrid stock. They are a mix between a debt and an equity. They don't outrightly dilute common shareholders in terms of share count, but they do affect the profitability of the business somewhat. You see, because what happens is that all these preferred shareholders actually receive a fixed dividend that is actually pretty high, somewhere between 5, 6, even 7%. Right. So this dividend is actually paid out to the preferred shareholders before the common shareholders can get anything. So if you think about it from that point of view, then yes, in that particular sense, it can be dilutive in some instances, but it will not really affect BMNR's business model, and I'll explain why. Of course, apart from this, in the event of bankruptcy, the preferred shareholders do rank above the common shareholders in terms of claims, and that is another benefit of the preferred shareholders. So BMNR can actually issue preferred shares to raise capital, but unlike common shares, they don't actually expand the share count for the existing shareholders, and so because of that, it is not immediately dilutive. So I'm going to explain this fairly simply using some simple numbers, and that we're going to build on this example later on to find out whether or not BMNR's valuation can really grow to become as big as what MicroStrategy has become. Right. So if you take a look at this example over here, very simply, I'm just going to define a couple of things before we start. Now, if you want to find the net asset value of BMNR, you take the total value of their Ethereum held on hand, you add the cash that they have on their balance sheet, and then you subtract all the debt that they have. And then that gives you the net asset value. Now, once you get the net asset value, you divide that by the total number of shares outstanding in order to get their net asset value per share. And you can see how that affects their share price later on. So in our example, BMNR starts with a holding of around 10 Ethereum that you're seeing over here. The price of each Ethereum is around $4,000, making the total value on BMNR's balance sheet in terms of Ethereum stand at around $40,000. So if you look at this formula over here, you take the value of ETH, which is $40,000, you add the cash that they have, which is zero, They have no staking returns because they are not staking this 10 ETH at the moment. Subtract that, they have no debt. Their net asset value right now is $40,000, which is basically the value of all the Ethereum they have on their balance sheet. From here, you divide this $40,000 by the 1,000 shares outstanding, and you get a net asset value per share of $40, right? So 40,000 divided by 1,000 shares, 40,000, $40 of net asset value per share. Now, if you assume a MNAV premium of 1.25, you get a BMNR share price of $50. And that is where we are starting our example today. Now, for the sake of simplicity, and because I want to show you certain things along the way, we are going to assume that BMNR never, ever, ever stakes this first 10 Ethereum that they hold. Any staking of Ethereum used in our example today will only be done with the Ethereum that they buy with the capital that is being raised. Okay, and so with that, let me use yellow to highlight this, so you know yellow is the numbers that are not going to change. So with that, let's move into try and understand preferred shares. So like I said, preferred shares are like a hybrid stock. They are a mix between debt and equity, right? And so this preferred stock, they actually issued some preferred stock to raise $40,000. Now they do so by promising to pay the preferred shareholders a dividend of 6%. And so 6% of $40,000 works out to be around $2,400 in terms of dividend payment every single year. Now, on top of that, they now have $40,000 of debt on their balance sheet. Now, this $40,000 of debt, they can go out and buy another 10 ETH at $4,000, which means right now, if you see this change that we have just made, right, they now hold 20 ETH at $4,000 per share, making the total value of Ethereum on their balance sheet stand at $80,000. Now they're going to be staking the new 10 Ethereum that they bought, which is $40,000. And if you take 3% as the staking yield, that's how you get this $1,200 that you're seeing over here. I'm going to be representing this in yellow, right? So again, I'm going to take you through 20 ETH. How did they get 20 ETH? They used the capital raise, 40,000, issued by the preferred debt to buy this extra 10 ETH. So right now they have 20 Ethereum on their balance sheet. Each Ethereum is worth $4,000, making the total value $80,000. Now thereafter, they stake the 10 Ethereum that they bought, which is around $40,000 worth of Ethereum at 3%. This means that they actually receive $1,200 in terms of staking returns. And then you have to bear in mind that because they raised capital through preferred shares, they now have $40,000 of debt on their balance sheet, as well as an interest payment or a dividend payment of $2,400. So if you go through this formula, value of Ethereum, 80,000, no cash because you have used all of it to buy the ETH on your balance sheet, plus the staking return, less the preferred debt and the preferred dividend, you end up with a net asset value of $38,800, right? So with a share outstanding similar, 1,000 shares outstanding, because there's no change when you issue preferred shares, the net asset value per share seems to actually fall a little bit at $38.80. Now, even with a 1.25 MNAV, that actually puts BMNR's share price at $48.50. Now, thereafter, this is where the magic happens. So the reason why this move is slightly dilutive to the net asset value is that because you're taking on debt on your balance sheet, and the debt needs to be accounted for when you're counting the net asset value. And when you take on debt to buy Ethereum and the Ethereum hasn't appreciated, you actually get hit a little bit in terms of the net asset value on your balance sheet. But that doesn't really matter because let's assume eventually Ethereum moves to $5,000 per share. So we are changing this to $5,000. Let me just put a dollar sign here. Now, this 20 ETH will no longer be worth $80,000. They will now be worth $100,000, right? Because the ETH per share actually gone up. Now, what you realize is that because you're staking ETH at 3%, when ETH goes up to $5,000, your staking returns also increase to $1,800. And so as your staking returns increase, what you actually realize is that the dividend is fixed. It's at $2,400. Right? So because of that, your staking return at some point can eventually pay off the dividend by itself, and all you have to account for is actually the debt on your balance sheet. So with this change, when the price of Ethereum jumps to $5,000, the value of ETH is 100,000. Again, no cash on the balance sheet. ETH staking return $1,800. The debt is still the same, 40,000. and the preferred dividend is still the same, $2,400. With that, the net asset value now jumps up to $59,400. And if you consider that there are 1,000 shares outstanding, this means the net asset value per share stands at $59.40. And if you apply an MNAV premium of 1.25, same throughout, you get BMNR share price today standing at around $74.25. And so now that we have seen what the preferred shares can do to the BMNR share price, let's just compare this to the original scenario. Let's assume you do not do the capital raise, right? The price of Ethereum goes up to $5,000. What happens is that your net asset value goes up to $50,000 and your net asset value per share goes to $50. And even when you apply a 1.25 MNAV premium to this, BMNR share price would only be $62.50 compared to the earlier price of $74. Now, this price actually changed because I linked the two formulas together, the price of Ethereum, right? So initially it was $74.50 over here. Once this goes to 5,000, you can see it changes a little bit. But you can tell basically that the preferred shares actually help to make the entire flywheel a lot more accretive to shareholders over the long run. Even if I add a similar staking return of $1,800, you can see that in the original scenario, BMNR share price will only increase to $64.75, which means that it still makes more sense to use preferred shares as a means to raise capital so that you can make this entire flywheel a lot more accretive to your shareholders. I think what is one interesting thing that you have to understand about the whole preferred shares mechanic is that this dividend, despite it being fixed, in bad times it can actually be suspended, which basically eases the cash flow for the business as well, right? So that is one reason why MicroStrategy likes to use preferred shares. Now, there's just one thing I want to cover before I jump over to talk about convertible debt. Apart from the suspension of the dividend, you can actually see that, as I was showing you earlier on, when the price of ETH actually goes up, it makes it a lot more accretive to shareholders. But the converse is actually true. So if the price of ETH drops to $3,000 per share, what you're seeing over here is that the staking returns, basically represented by this yellow box over here, drops to just $600. However, as this drops, because the preferred dividend is fixed at $2,400, it severely reduces your net asset value to around $18,200, right? So because of that, even with an MNAV premium of 1.25, BMNR share price would be $22.75. Compare that to the original scenario. If the price of Ethereum drops to 3,000 over here, your BMNR share price would only be $37.50. So when you use preferred share, it's a form of leverage that actually increases the value for shareholders when the price of Ethereum goes up. But similarly, if you use it too much when the price of Ethereum goes down, shareholders are likewise hurt to the same amount. Now, the second weapon in BMNR's arsenal is what we call convertible debt. Now, I'm highlighting this in, let's say, pink over here so that you can see the difference. And so what a convertible debt is, as the name suggests, is a form of loan that can later be converted into equity if a certain condition is met. Now, this condition usually has to do with the share price rising past a certain level, which means the existing shareholders will already experience some form of capital appreciation before the potential dilution later on. Now, because this convertible debt can be potentially converted to equity later on, usually the interest payments on this form of debt is not very high, usually around 2 to 3%. Think of it as, telling someone, lend me money now at a low interest rate. If our company performs well and the stock price climbs, you can choose to convert that loan into shares instead of just collecting on your capital. And so this way, what happens is that BMNR gets cheap capital up front. Investors get to enjoy the upside or the potential upside if the business succeeds. And this way, the dilution only happens after shareholders enjoy the capital appreciation. I'm going to assume the same starting scenario over here. I'm going to jump down. We're going to look at the original scenario just to remind all of us. We're starting with 10 ETH on BMNR's balance sheet. This 10 ETH will not be staked, and the price of Ethereum is $4,000, making the total value 40,000, right? No cash, no debt, net asset value of 40,000 divided by 1,000 shares outstanding. That puts their net asset value per share at $40. 1.25 MNAV brings BMNR share price at the start to $50. Let's say BMNR goes out there and issue convertible debt of around $80,000. Now, this $80,000 of convertible debt has a very special condition. They're only able to convert this into shares if the share price reaches $80. Okay, I'm going to highlight this in pink so that you remember. This convertible debt is a capital raise of $80,000 that they're only able to convert into shares if the share price reaches $80. So with this $80,000, BMNR can take this 80,000, go out and buy an additional, not just 10, but 20 Ethereum. So let's change this number to 30 over here because they have the 10 on their balance sheet and they bought 20 Ethereum. Now, each of these Ethereum, like I said, costs $4,000. And because of that, the value of Ethereum on their balance sheet will become $120,000. Now, because they use all the debt to buy Ethereum, there's no cash on their balance sheet. And if you stake the 20 ETH, which is around 80,000, if you stake the 20 ETH and you get a 3% return, that's how you get a staking yield of around $2,400. But you have to remember that because you issued the convertible debt, you now have $80,000 of debt on your balance sheet, as well as an interest payment of $2,400. How do you get this $2,400? We are assuming a 3% interest payment on the convertible note. Okay, I'm just going to call this CD, right, for convertible note. So 3% of $80,000, that's how you get $2,400. This is basically going to be offset by the staking yield of 3%. Now, of course, at this point, I do want to point out very quickly, if BMNR can raise this convertible debt not at 3% but at 2%, this actually changes their interest payments to $1,600. Now, if they are still able to stake the $80,000 worth of Ethereum, getting a 3% return, that means their staking yield can actually more than offsets their interest payments, and it allows them to buy even more Ethereum using the balance of their staking yield as well as the interest payments. But just for simplicity's sake, we are just going to assume that the ETH staking returns is $2,400 and the interest payments on the convertible debt is also $2,400, which basically is a write-off for each other. And so in this particular scenario, what you're noticing is that the net asset value still stands at $40,000, which is the slight difference that has compared to preferred shares. You see, because preferred shares has a very high dividend associated to it, so when you account for the dividend that you have to pay on the preferred shares, sometimes that is going to affect the net asset value before the price of Ethereum moves. But because the interest payment on a convertible debt is actually fairly low, if the staking yield can cover it, you won't actually see any effect to the net asset value immediately. However, later on, if the target price has been reached, there will definitely be dilution to the net asset value, and then we'll explore that later on. Right, so with this setup right now, what we're having with the convertible debt, what you're noticing is that the net asset value, like I said, doesn't change, 40,000. So with 1,000 shares outstanding, right, the net asset value per share stands at $40. With an MNAV of 1.25, BMNR share price is still $50 despite the capital raise and holding more Ethereum on their balance sheet. And so from here, we're going to use the same example or the same assumption. The price of Ethereum eventually will climb up to $5,000. Now, when that happens, the value of ETH on their balance sheet will grow to $150,000. And at the same time, this yellow box over here, the staking yield would actually increase to $3,300. Now, at this point, the staking yield will more than offset the interest payment, which means they can actually use that surplus to go out and actually buy more Ethereum. Okay, so but we won't be considering that right now. So what we are doing is just we are adding in the staking yield as if it is cash. So if you use this $150,000, adding the staking yield return of $3,300, subtracting convertible debt and the interest payments, you end up with a net asset value of $70,900. Now, if you assume that there are 100 shares outstanding, this means that the net asset value per share stands at $70.90. If you apply a 1.25 MNAV, that means BMNR share price would then be $88.63. Again, once I compare this to the original scenario, $5,000 ETH will only be $62.50. All right. If you use the convertible debt, the BMNR share price will end up at $88.25. So that is why you can actually see what I mean by the original shareholders will be able to enjoy capital appreciation. But if you remember at the start of this example, we actually said that there is a condition. You read this pink line over here, it says that the convertible debt can be converted to shares if the price of BMNR reaches $80. And what we have when the price of Ethereum went up to $5,000 is that the BMNR share price actually went up to $88.25, which means that the debt collectors can say that, hey, you know what? I don't want you to pay me back the $80,000. I want 1,000 shares. Now, why 1,000 shares? Very simply because the 80,000 that they actually lend to BMNR, divide by $80, that will actually give you the 1,000 shares. Basically, what is going to happen in terms of the mechanics over here, BMNR can keep all the 30 Ethereum on their balance sheet. There's no changes over there. And then they can still stake this Ethereum at 3% to get their staking returns over here. Okay, so let me change this. Their staking returns is $3,300. However, because they are issuing the shares to wipe out the debt, there's going to be zero debt over here and zero interest payments. Okay, there's going to be zero debt and zero interest payments. What is going to change, however, is the shares outstanding. Instead of 1,000, now they're going to add another 1,000 shares and there's going to be 2,000 shares outstanding, right? Like I said, $80,000, which was the capital raise, divided by $80 per share, that is the target price. That means you have to add an additional 1,000 shares. So if you see how this works out, the value of Ethereum, $150,000, staking yield $3,300, making the total net asset value $153,300. With total shares outstanding of 2,000, this means the net asset value per share has increased. Do you remember just now? It was only around $70.90. Now that has increased to $76.65. So that means even after the conversion, it can actually still be accretive to shareholders and not always dilutive, right? And if you assume a 1.25 MNAV, this means that BMNR share price will be around $95.81, even after the dilution. And so one very interesting thing to point out over here, even if MNAV collapses from 1.25 to 1.1, what you're seeing is that BMNR share price will still be around $84.32 because of the increase in net asset value per share. And so because of that, that actually adds in an additional layer of buffer for the shareholders, and you can see why shareholders are generally okay when companies like MicroStrategy and even BMNR goes out to raise capital through using convertible debt as well as preferred shares. And so without using the preferred shares or the convertible debt, BMNR's price would only be $62.50 should the price of Ethereum rise to $5,000, and we have shown that in both cases above. And so what that actually tells us is that BMNR really have many different levers that they can pull in order to keep up their pace of growth of ETH per share and to continue to drive value to shareholders. But I think what is even more important is that by doing so, they are able to keep their number of shares outstanding in check, which means that in the mid to long term, this is going to be beneficial for the valuation of BMNR. And with that, I'll see you in the next one.